Absorption costing, a method often employed in manufacturing, serves as a crucial framework for understanding and analyzing the profitability of produced goods. Under generally accepted accounting principles, GAAP, manufacturers are required to allocate periodic production costs across all items produced. This allocation process involves dividing costs related to labor, materials, and factory overhead between items sold and those still in stock. The complexities of absorption costing arise from the necessity to encompass all manufacturing costs, both direct and indirect, in the final product cost. At its core, absorption costing includes direct material costs, direct labor costs, variable manufacturing overhead, and fixed manufacturing overhead. This comprehensive approach means that every cost associated with the production of a good is taken into account, allowing businesses to ascertain a more accurate total cost for each product. However, while absorption costing meets compliance requirements, it does not always provide a clear picture of individual product profitability. This is particularly relevant in light of the fact that financial accounting principles do not require overhead costs to be causally related to the demands of individual products. As a result, many companies continue to allocate overhead based on direct labor, which often constitutes less than 5% of total manufacturing costs. One of the notable characteristics of absorption costing is its allowance for a single plant-wide burden rate to allocate overhead to products, regardless of the diversity in production processes. This can be advantageous in terms of simplicity, but it also raises questions about the accuracy of cost allocation. The traditional method of absorption costing, while compliant with GAAP, can lead to significant distortions in product costs. For instance, if a company produces multiple products with varying levels of complexity and resource consumption, using a single cost driver can result in misallocated overhead, leading to overcosting of some products and undercosting of others. Such discrepancies can have profound implications for pricing strategies and overall profitability. When discussing absorption costing, it is essential to contrast it with variable costing. Variable costing only accounts for direct costs associated with manufacturing, excluding fixed manufacturing overhead. This distinction is crucial because it highlights how absorption costing assigns a portion of fixed manufacturing costs to each unit produced, whereas variable costing does not. As a result, absorption costing can provide a more comprehensive view of total manufacturing costs, but it also complicates the calculation process. Despite its advantages, absorption costing presents several challenges. One of the most significant issues is its potential to lead to suboptimal decision-making. By assigning all manufacturing costs to products, regardless of their actual consumption of resources, businesses may continue to produce unprofitable items simply because the absorption costing framework does not accurately reflect the real costs involved. This can create a scenario where companies are locked into producing products that are not viable in the long term, simply due to the way costs are allocated. Moreover, absorption costing can produce artificially inflated or deflated profit figures. In some instances, a product may be assigned too much overhead, resulting in a misleadingly low profit margin. Conversely, other products may receive too little overhead allocation, leading to an inflated profit margin. Such inaccuracies can create confusion and lead to poor strategic decisions regarding product lines and pricing. While there are some benefits to using absorption costing, such as its compliance with GAAP and ease of calculation, the disadvantages often overshadow these positives. The method's simplicity can be appealing, especially in complex manufacturing environments, but it sacrifices granularity and the ability to establish cause and effect relationships between cost and production processes. This lack of detail can ultimately hinder management's ability to make informed decisions regarding product profitability and resource allocation. In contrast, activity-based costing, ABC, offers a more nuanced approach to overhead allocation. By utilizing multiple cost drivers, ABC allows for a more precise understanding of the costs associated with individual products or services. This method can provide valuable insights into the true cost and profitability of products, enabling better decision-making. However, implementing ABC can be resource-intensive and may not be suitable for all manufacturing environments, particularly those where overhead costs are minimal or primarily volume-related. The interplay between management decisions and organizational costs cannot be overlooked when discussing absorption costing. Leadership plays a pivotal role in shaping the cost structure of a manufacturing organization. Understanding the underlying cost drivers and embracing change is essential for effective cost management. As organizations evolve, so too must their approach to cost allocation and production practices. A culture of continuous improvement and a willingness to challenge past decisions are critical for long-term success. One particularly concerning phenomenon related to absorption costing is what is known as the absorption death spiral. This occurs when a company relies on outdated costing rates based solely on prior year's costs or budgeted figures. As market conditions change, this reactive approach can lead to a cycle of declining sales and increasing costs, ultimately jeopardizing the company's competitiveness. For instance, if a manufacturer experiences a temporary drop in sales but maintains its overhead structure, the resulting higher bid prices may further reduce sales, creating a downward spiral that is difficult to escape. In conclusion, while absorption costing remains a widely used method for allocating manufacturing costs, it is essential for organizations to recognize its limitations. The simplicity of absorption costing can be alluring, but it may provide a distorted view of product profitability. To navigate the complexities of manufacturing costs effectively, businesses must invest in understanding their cost structures and consider alternative costing methods, such as activity-based costing, that offer greater accuracy and insight. Ultimately, the goal should be to create a robust framework for decision-making that accurately reflects the true costs of production, enabling organizations to thrive in an ever-evolving marketplace. By embracing a culture of continuous improvement and challenging traditional costing practices, manufacturers can position themselves for long-term success and profitability.